Hello and welcome to FidelityConnects. I'm Pamela Ritchie. AI is reshaping consumer behavior, changing how people earn, spend, and discover products, even as its full impact is still unfolding. At the same time, our next guest notes a shift in consumer preferences away from goods towards experience, wellness, and premium brands as consumers become more selective with their spending. So how could these trends redefine or continue to define the overall consumer landscape? And how should advisors and investors think about positioning portfolios in response? Joining us here today to break it all down is Aneta Wynimko. She is portfolio manager of the Fidelity Global Consumer Brands Fund. A warm welcome to you, Aneta, from London. Nice to see you.
Thank you. Nice to see you as well.
Yeah, delighted to have a chance to speak with you. Let's begin by opening up the discussion a little bit about consumers, the preferences that they have had. We'll talk about how that's going to change probably, or how you think it might change. But the consumer has been balancing a number of different things even before we were talking about oil shocks. What's sort of the state of the consumer, would you say, on a global basis?
Oh, well, consumer has had a lot of things thrown at him over the last few years, and as we entered beginning of the year, there were some green shoots emerging. Obviously, the consumer confidence has been depressed for a long time, and I think coming into this 2026, people were starting to feel a bit better. And there were some indicators of a bit more optimistic approach. And then we get another crisis, another global geopolitical situation that is difficult to forecast and difficult to deal with. So I think the mighty consumer is still there, but is dealing with quite a lot.
So the sector itself, when you take a look at the shares, the stocks within it, what makes up the portfolio, I mean, there's some argument that it's looking like, because there were green shoots, it's a bit of a bargain. I mean, is that fair? This might be an interesting time to look at it because it has had so much thrown at it in the form of bad news and therefore repricing.
Yes, the consumer sectors, the traditional, whether it's staples or discretionary, those sectors are probably the most out of favor sectors when it comes to when it comes to investor sentiment. Obviously, when you have a situation with lots of uncertainty, with energy prices going the wrong way, consumer is in the middle of the squeeze, and the investors are very quick to react, and they are very quick to sell those companies because it's obviously quite easy to figure out that there is going to be pressure. So those stocks react really fast and they become quite cheap fast, which what has happened.
Yes, that is what happened. And in terms of recovery, you're looking at global brands, you're looking at a global consumer. There's been discussion in the form of other types of asset classes, areas of the world that are more self-sufficient on an energy front versus others. Does the discussion for the brands and the companies that you look at become very regionalized necessarily, or not?
I think it's quite difficult because, again, the situation is very fluid and can change really quickly. And obviously companies have strategies in place. And I think those that execute well and they use technology and they have local teams in place, they know how to react to this environment, especially that they have dealt with a bit of a similar situation when the invasion of Ukraine started, and that also had an impact on commodities and confidence. So it's hard to pinpoint regions or segments of the consumption investment universe that really stand out as beneficiaries of the current situation. But it's more about how the companies maneuver through this environment and to what extent investors have overreacted, because this is all about near-term threats that hopefully will be resolved, while their business opportunities are hopefully very much long-term in nature, and we need to think about long-term earnings when trying to value those companies as opposed to the current quarter estimates, which obviously are quite fluid.
When you go through areas like leisure, where people want to spend in terms of apparel, experiential, I think is what we mentioned when we were introducing you, where is the consumer leaning? If they were less pressured and they were in a position to just go with what they're interested in, what a layer of better technology allows them to buy or sell or get themselves organized for in terms of trips and experiences and so on, where is the consumer leaning? Where are these trends taking you?
I think the trends towards spending on travel, entertainment, experiential consumption is quite well established. And I think the preference for experiences, maybe this is one of the things that we got out of COVID, that really is quite a change in people's attitude to how they live their lives. So maybe less spent on physical products, of which I think everyone has plenty, and much more preference for this kind of special time with family, with friends, travel, going out, but also exercising and doing things for yourself, for your body, for your health. So I don't really see this changing anytime soon. And obviously, depending on consumer confidence and what they can afford, they might slightly adjust their behavior. But I think the preference for spending on leisure is quite well established.
It's interesting. Are certain areas of what you're talking about within perhaps wellness particularly more inelastic? So if people are investing on, I don't know, their look on some level, whether it's their hair or wherever, those are things that you perhaps wouldn't give up even in sort of a recessionary moment. I mean, there are areas within what you do that would be more or less inelastic. You might cut restaurants, but you might stick with others. Can you just sort of talk a little bit within the coverage that you have, which areas are quite inelastic?
Yes, I think there is a bit of, like, consumers are very clever, and with the tools, the digital devices, they can figure out what best value they can get, how and where, and they are doing that. But there are situations where it is quite hard to substitute. So, for example, one of the companies or the trends that has emerged in the recent years is aesthetic treatments, where men and women move on from just using, facial cream to injectables, because those are much more efficient and effective. And what we have seen is obviously you create patterns of behavior where something that might be perceived as, at the beginning, it was very much niche. Then it was seen as a luxury and only the wealthiest people were able to afford it, to now, for a lot of people, becoming something they have to do, because obviously their looks will change if they don't keep doing it. So you have these categories which are emerging, and they are emerging because on one hand, the demographics of the society are changing. People are getting older, but then also people do create the images on social media and are very much aware of their looks. While on the other hand, the progress in science kind of creates new products, new ways that are maybe safer or maybe much more fast acting. So we see this kind of niches of consumption that are emerging, and it is happening really fast because people talk about it on social media, and then the solutions are adopted quite fast.
So just to sort of round out part of the wellness discussion, the other piece of that, or seems the obvious piece to me anyway, is sort of exercise, everything to do with that sort of realm. That is easier to invest. There are big gyms that are public, that for instance, but there are also probably trends in there that we don't know about. What other ones are there on sort of the exercise side of wellness, I guess?
Yes, I was just today talking to a Chinese company, and they talked about a marathon, and I don't remember in which city.
You can
but
invest in marathon?
You can't. Sadly, you can't. But what they've told me is that 500,000 people signed up, but there were only 20,000 spots available. So even to run a marathon is not so easy. But sadly, there isn't a way to invest in the public market in that. Obviously, a way to invest in fitness is to buy some of the companies that provide sporting goods. Unfortunately, that space has become very crowded. Nike and Adidas used to dominate this space, but they, a few years back, to an extent misexecuted and tried to limit that business to only direct to consumer, which opened the door of wholesale to other brands. And today in that space, we see a lot of companies. So contrary to this injectable aesthetics where you need regulatory approvals and lots of R&D, in sportswear, if you have a good idea, if you come up with strong product, which can be made in China in the same factory where other companies, the big companies, are making the product, the entry barrier is not that high. So I think it's also very important to think about, okay, there could be an interesting niche, and this is where consumers spend their time, but how difficult it is to provide products and what's the level of competition.
So let's sort of bring in AI to introduce the discussion of leisure. So AI obviously could be applied to, I suppose, any version of any company doing some of the things you mentioned on the wellness front, booking gyms, classes, all that kind of things, and also probably booking appointments if you wanted to have them. And the pharmaceuticals, as I understand it, are one of the hugest beneficiaries in terms of research from AI. I might ask you to comment on that in a sec. But just to move to leisure, I mean, one of the earliest examples of the agentic AI was you can book your trip, like that, because you just say what you want to do and somehow the airline, the hotel and everyone else all talk together and you come out with a trip within minutes. But just sort of apply that to what it's meant to the travel leisure industry so far. Is it accretive at this point? Is it something you look at carefully?
Yes, of course. And obviously here the big question that emerged is to what extent AI creates a threat for OTAs, the likes of Booking, Expedia. Because obviously the way I am looking at AI is it is an intermediary. It's a very clever, very efficient intermediary. And it's going to displace a lot of intermediaries that are maybe taking too big a rent in a space where things can be automated. So obviously we have to look at the two sides of the coin. AI might create more ease and more access in terms of coming up with ideas where to go and what to do. But at the same time, AI can act as an intermediary and allow consumers to book directly and maybe at more attractive prices because that rent that was paid to the more traditional intermediary will be lower. There will be still a rent, but it will be lower. So this is happening in a lot of sectors, and because companies take much longer to adopt new solutions because they need to be sure there's cybersecurity, there's a lot. Consumer, it's from one click to another. They change their behavior to what's best and most beneficial to them.
I mean, from a lot of different industries, speaking about AI, it still comes back to a quality company in a lot of ways. I think you and I spoke a little bit about not so much shipping, but sort of the cruise industry. Although you could use AI on a number of different levels to make all kinds of things logistically better, you still have to own a cruise ship. You still have to dock it somewhere. I mean, there's still sort of the hard asset piece. Does that become quite attractive and have some moats around it to an extent when we're talking about, again, travel and leisure?
Yes. I actually am trying to find businesses that have those physical moats. businesses that offer more than just being an intermediary connecting two parties, and cruises or also hotel companies. It's a good example because they are very close to the asset, or they own the asset, and they maximize the use of the asset and the yield on the asset. But obviously, here we have to think about the demand, the preference of consumers, as well as the ease of entry of competition.
When you look around the world, tell us a little bit about whether those trends that you've mentioned, wellness, leisure, these are all experiential, as I might point out. Are they somewhat the same globally? I mean, is that what a consumer that has some equal amount of money that's disposable in Europe, South America, North America, Asia would be looking for? I mean, do the trends line up globally?
They do. The American consumer is the wealthiest consumer, so obviously they are the most relevant in terms of the business exposure for a lot of global companies. But I see the same behavior. I see it in Europe, but here the consumer is a bit maybe less well off, more under pressure from the macro point of view. I see similar preference in China, but again, there the macro situation has been quite challenging for quite a while now. So maybe I see the willingness, but maybe not enough confidence to actually spend on the travel to Europe from China has declined quite dramatically. And it's not because consumers can't afford, it's because they don't have the confidence to spend on big ticket, long haul journey. So I think the preference is there. The ability is the question.
That's really interesting. So enter the discussion of how the shift from apparel, which you mentioned at the beginning, apparel, but other types of goods and things that we wear and perhaps buy for our gardens and things that we bought in the pandemic, for instance, it does seem like there is a very long hangover essentially from that because we just bought so much at that time. The inventory story was sort of out of whack. It took a while. Is it still that way?
I think there's still probably an overhang in terms of what we have in our houses, on our wardrobes. But it has been quite a long time. So fashion changes, things break, and there's the natural replacement cycle that is ongoing. But companies need to help. They need to come with more exciting products. And I think coming out of COVID, there was an element of maybe some people bought too much, or they had too much kind of money that was available because the governments became quite generous. But I think some of the companies or some of they got a bit lazy in terms of innovating because maybe business was too easy, and taking pricing became also acceptable because everyone has done it. And only more recently, I see a very real and serious effort to speed up innovation, to speed up creativity, and actually get the consumer to open their purses and spend on things that maybe they don't need, but maybe they would like.
Right. It's interesting. Well, I suppose everyone sort of has that inclination to an extent, but what about the generations? We often talk to you about demographics and the ideas that stick with a younger generation that may not have the money to buy it, but it certainly can be an influence ultimately. What is hot, new, interesting that perhaps younger consumers want, can't yet afford, but you see coming up through the ranks?
So the young consumers, there's a bit of a paradox. I think people call that the Gen Z paradox. So it's the generation 18 to 28, who actually, when you look at the consumer confidence by cohort, the Gen Z, they have the highest confidence in the situation improving. And so it is a bit surprising. And I'm trying to understand why is that the case? And I think it's a very interesting generation because they came kind of age after COVID, and they faced inflation and all sorts of things. So it's a very kind of a resilient generation. They are not used to Goldilocks. They know things are tough, and they have this kind of approach. They can make things happen, and I think this is how they approach life. So the volatility, uncertainty, which I think is more difficult, maybe especially for the millennials, which had a good 10 years out of the financial crisis, and then things started to go wrong. I think this generation has this approach of kind of finding solutions. They are probably going to be, even though the unemployment rate for the young people is quite high, close to 10% in the US, so it's not easy to find jobs. But I think they are the generation that is really able to embrace AI and actually find ways of making money. So I've been looking, for example, at Roblox, which is the gaming platform. And obviously there's a lot of criticism because it does attract a lot of kids. And there's scrutiny of what happens on this platform. But just to show some numbers, last year, 3.5 million people developed games on this platform, which was 1 million more than the year before. And something like 70% of those developers are like solo developers. And to be a developer, you need to be more than 13 years old. So there's a lot of young kids actually developing games and starting to earn thanks to AI, because Roblox gives you also the AI assistant and makes making games easy for those kids who are creative. They like doodling, they come up with things. So I think maybe that's why the confidence among this generation, contrary to what we would expect, is high, and they can see the opportunity, while maybe the older consumers, they see the negatives. They see the AI destroying jobs news and all sorts of headlines that have been impacting sentiment.
That's
so
interesting. Yeah, I mean, just to hear that type of confidence with a new technology sort of at their back, pushing them forward. There's a propulsion there. That's fascinating. Are we still going to watch movies? They're all AI generated now. Are we still going to watch? Is Netflix still an interesting? I mean, do you still go to the streamers? Is that still part of our lives? What we want to spend money on in terms of subscriptions and so forth?
I think there are some subscriptions that have become so entrenched in our life, and Netflix is the long form, is the time on the couch in the evening when one wants to relax and lean back as opposed to leaning forward and looking for things. So I think the space for Netflix. But they need to innovate. They need to keep their position as the most kind of highest quality content that people want to watch when they want to relax. And their biggest competitor today is YouTube with user-generated content.
That's so interesting and very global. I mean, or at least that's been the attempt. It looks like, it brings in people from all over the world, sort of a global experience watching a lot of the things on some of those platforms. I have to ask about food, beverage. There have been times when it's been very interesting to you, other times where it's been just hard to invest. And just a couple of thoughts on sort of food and beverage.
I think the overall space of food and beverage is difficult. The inflation of food, but also especially in the space of spirits, has been very high because consumer is resisting the price points. And consumer is also very clever because with Walmart, for example, providing fast delivery, now the consumer looks at the price of takeaway and price of food, the food that you can get from Walmart, the ready meals. So the market here, the competition is obviously technology enables like the established entrants to compete with a completely different segment of the market where they were not operating before. So the food industry is also very fragmented, and as as especially companies like Nestle, which have very big R&D budgets and history of coming up with innovation, which for the last years maybe has been disappointing, but there's new leadership and hopefully they go back to what they've been known for. I think there's need for innovation. There's need, we all know that even the fresh food, the organic food, the amount of nutrients that we need and vitamins, it's not there because maybe there isn't enough of nutrients in the soil. So I think there's opportunity for innovation, but it's not an easy space, especially if there's inflation again in commodities that makes things quite challenging. But food, there's like adjacent categories to food. So whether it's coffee, where I think the consumer very much looks for innovation and for new products, and it works really well in the way we live our kind of on-the-go lives. Or pet food, I think that's quite an interesting category, and again, category that has been impacted by COVID, because through COVID we saw big adoption, especially of dogs, and unfortunately, many of those dogs have ended then in shelters. But what continues, maybe not unsurprisingly, is the adoption of cats. And partially it is driven by TikTok. There is this new phenomenon of a cat dad. So men adopting kittens and showing them on TikTok. And here Nestle is actually the dominant player in that space. They have integrated R&D and manufacturing, and the Purina brand is one of the top brands. So when you look at those global companies, you really have to almost dismantle what exposure do they give you and what is happening in each of the end markets, and is there anything interesting going on that actually might help them even in a challenging environment.
Netflix needs to come up with a remake of Must Love Dogs, I think. That's great. Just as a final thought, we sort of began talking a bit about the state of the consumer and the idea that this general area could be a bit of a bargain. Just kind of take us back to the investment case for taking a look at the global consumer and ultimately the fund.
Yes. So what I try to identify really is the best-in-class, well-managed companies with strong balance sheets, with strong brands, companies that adopt technology and use it both to innovate, but also to manage the costs and procurement. And this is an ongoing effort. But the market today is looking for AI, of semiconductor supply chains. Like the focus of the market is very much somewhere else. So those good businesses, compounders, have been almost put aside and no one is paying any attention. So it really is space out of favor. It's space where even looking at the dividend yields, there's a lot of companies that are paying good dividends, still growing, and they've been around for sometimes more than 100 years. And AI is not going to displace them. AI will probably allow them to become even better businesses. So as always, plenty of opportunities, but obviously the market is a voting mechanism, so there needs to be enough interest for the stocks to go up.
Okay, very interesting in the sectors that you play and research and invest on behalf of investors. Aneta Wynimko, thank you so much for sharing your thoughts with us and joining us here today.
As always, pleasure.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.